Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a little bit confusing, misleading, and take us off course. And I hope to make it actionable, understandable, and clear. What a week. What a show. Have we got a lineup for you or what? We're going to be looking at this week. A buzzword, no doubt you've heard. We're looking at inflation. What are we supposed to do? What are we supposed to not do? I'll talk you through it. We're also going to be camping out in a magazine I suspect no one's heard of or looked at before, but is sent to me every month. It's Financial Planning Magazine. Ooh. And in this magazine, there are actually two articles we're going to look at. The first one is, they're coaching me here, right? They're teaching the advisors. It says, helping clients avoid the top 5 financial regrets. Aha, you're going to want to know what that is. And then we're also looking at another article in this very magazine, the April 2024 magazine, headlined, Can Active Exchange-Traded Funds Outperform into More Portfolios? You know, one of my favorite topics is the active versus passive investing debate. Just when you feel like the war has been won, whoop, a little skirmish breaks out in a field we thought was previously conquered. So we will have to see what must be done there. But let's start it out at the top. CNBC article. This week, headline reads, Fed Chair Powell says there's been a lack of further progress this year on inflation. This came out this Tuesday. Fed Chair Jerome Powell said the U.S. economy has not seen inflation come back to the central bank's goal. Dun dun dun. Pointing to the further unlikelihood that interest rate cuts are in the offering anytime soon. Here's the quote. The recent data have clearly not given us greater confidence, and instead indicate that it's likely to take longer than expected to achieve that confidence, he said during a central banking forum. Let's pause. Little trip down memory lane. Do you remember just how many articles had come out in the last 12 to 18 months with rock-solid predictions about, well, see, that the Fed's going to cut rates here, and that's going to for sure happen then, and what that means is you're supposed to buy this, and you can't buy that, because we've got to remember those predictions so that in the future, when the soothsayers are giving us their edicts from on high, we can remember, aha. But what about that time you all sought to predict the Federal Reserve's interest rates movements? So what is Jerome Powell, the Federal Reserve Chair, telling us now? He doesn't think he can cut. Collective gasp, but we were all told he would cut. We were all told certainly he would cut, that he had to cut, that he was going to cut. It was going to be a cut. Well, turns out predictions are hard, especially about the future. As the great Yogi Berra once said. So this, to me, when I read this article, I thought, as if we needed another reminder. Of course we do. Be very suspicious of consensus predictions from industry about interest rate movements. Because what this does, there was a whole host of folks who, and this may be a listener, certainly not advice that I was given to it, who bought investments using large amounts of leverage and anticipated interest rates dropping so they could refinance those investments and move on about their business, about their life. Those bets that were made are increasingly looking unfavorable to the investor. So anytime your investment thesis is predicated on the movement of interest rates in the short term, that's a layer of risk. People do it and make tons of money. There's nothing immoral about it, nothing wrong about it. From a morality standpoint, it could be wrong from a risk profile standpoint and returns over time, because you see this risk. If, as an investor, the average plain vanilla index fund investor's got nothing to worry about. Don't need to worry about it at all. If you're in a bond fund, you don't really need to worry about it at all if you've got a long enough time horizon. If you're using cash management strategies of putting your money in money market funds, you're probably looking at this, rightfully so, and realizing, oh, this is good for you because it portends further lengthening the time at which you'll receive high interest rates on your money market account. But here's what I want us to be suspicious of. One is we should take a dim view of investments that are predicated on guessing correctly the Federal Reserve's interest rate moves. Well, what's an example of that, Robert? Well, it might be buying a piece of real estate in year 1 and trying to sell it in year 3, hoping to buy it at this interest rate environment and sell it in another one. People do it. They make money on it. I don't think it's a 50-year or 100-year plan. I think it's difficult to produce that over a long period of time. So I'd rather you invest in something that you can hold for 50 years and not think about interest rate moves. But what is the danger also that can occur is that people will read this headline and say, oh goodness, here it is. It's the 1970s. I've seen this before. I was around, or I've watched movies or read articles about the 1970s. I know what happened. It was inflation. And common stocks did poorly, and commodities did well. And therefore, here's my if-then statement. If inflation continues and accelerates, then commodities are going to do best. Now, what could be so wrong about an investment thesis like that? Well, it's got a bunch of holes in it, like Swiss cheese. No one actually knows. Not even Jerome Powell. You think if anyone's got access to good data, it's probably Jerome Powell. You don't think he's got an army of analysts telling him exactly what's happening on inflation since the whole world is watching him? The whole world is watching him. He doesn't know. He is confessing that in these articles, the CNBC article. He's saying, I kind of thought we might see it abate, and now it hasn't, and so we're just waiting and going to see when it abates, this inflation. And they've got a goal, and their inflation goal's not being hit, and they thought it would be, and so did all the experts. So he has a 2% inflation goal. This is a quote in the article. More recent data shows solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. So we can read between the lines here. He doesn't feel like he needs to cut rates. And here's the deal. A good investor with a good investment plan is not going to lose an ounce of sleep about that. If you're set up correctly, you're not going to want to go in and out. And this is why I take a dim view of someone saying, hey, I'm going to rotate into commodities. Or I'm going to kind of hide out in this asset class, let inflation do its thing, and then when inflation goes back to normal, then I'll bounce back to other asset classes. Friends, that's a fool's errand. It's an impossibility. If someone knew when inflation would take off and then when it would abate, and they knew the exact year, Federal Reserve Chairman Powell would just hire that one person. Hey, I got Larry. He did his undergrad at Texas A&M. We're just going to listen to him. He can predict when inflation will go up and when it will go down. But you and I both know that's not possible, and it's not possible with Larry or an army of thousands of Larrys. We don't know. So the best investment plan is actually not, oh, great, I'll rotate into here and go into here. In the 1970s, what would the best thing have been to do? Consistently buy common stocks throughout the entire decade, in spite of all the inflation, in spite of stock prices going down and their real value, not their nominal value, because inflation was raging. But I think it was Death of Equities article came out in, I'm going to say maybe 1979, don't quote me. And that was the bottom. That was the best time to buy. So don't fall for that trap of, and it's I completely understand why someone would fall for this trap. Completely. It's paradoxical that we couldn't just move money into investments that are good during inflationary times and pull them out when inflation goes away, but that's not how it works. It doesn't work. You can't do that. There's a lot more to be said there, but stick with the tried and true. You know that first one. Keep that investing simple. Just keep it simple. Now to our favorite magazine, Financial Planning Magazine. This seems like the last magazine to ever exist. It feels like all magazines are going away. They don't. At our house, we're trying to keep Food Network magazine alive and a couple others, but they're hanging on for dear life. I get this one. They just sent it to my house. Here we go. Article by Nathan Place. This is April 2024. Helping clients avoid the top 5 financial regrets. All right. Can you, listener, in your mind, identify the top 5 financial regrets without me telling you? It's actually kind of hard, but this is a survey. So researchers surveyed 2,000 adults at the end of 2023. and found that 81.6% of them regretted something about their financial decisions that year. And they didn't take, this is the article, and they didn't take these mistakes lightly. 68% said their mistakes caused them significant stress. It's an emotion many financial advisors have seen firsthand, especially from new clients. And this is true. I can relate to this. This is a quote from Marianella Colada, the CEO of Tobias Financial Advisors in Miami. They say, when we meet with clients for the first time, they feel regret on so many levels. Yeah, I can tell you that is exactly the experience that I have plenty of times. I think it's true for all of us. I think all of us have regrets. We all look back and say, ugh, why did I do that? Sometimes that's just part of our education. It's just part of your financial education is making mistakes. But here they are, top 5. Numero uno for my listeners in Spain. Not saving enough for retirement, number 1. Number 2, missing out on high interest rates. Number 3, too much credit card debt. Number 4, not saving for emergencies. Number 5, and my favorite, buying too much property. Whoa. I'm gonna camp out on the ones that I feel are the most important for us. Okay, probably not surprised, not saving enough for retirement. This happens, and it's a huge regret. The quote by Brandon Gregg, a CFP at BBK Wealth Management in Lafayette, Indiana. I almost said Louisiana there. He said, this is the biggest regret I see. Older respondents feel this, of course, more than young, because you have time if you're young. But the good news here is that the best thing you can do is just start tomorrow. There's a great quote in here. I paraphrased, but I'm going to read it directly. Ben Lex, who's out of Hudsonville, Michigan. Man, these towns. The good news for those people is that even though the best time to start investing was yesterday, the second best time is today. And that's the attitude I like people to have. Hey, if you're behind, okay, that's not ideal. Let's just pick up the pieces and start out tomorrow, and let's see what happens. Tom Brady was down 28-3 in the Super Bowl. Did he give up? Nope. Neither should we. Missing out on high interest rates, this is a big one. So what I find, hey, come in for a meeting, and there's a bunch of cash in a bank at a legacy major bank that maybe you picked up in college or that your parents directed you to, and they're paying you nothing on interest. So there's this gap where you can earn 5.27% today in Vanguard's money market fund and a similar number in various other money market funds. Or you can just kind of sit with your dunce cap on at a major bank. Wells Fargo, Bank of America, JP Morgan, paying you nothing, paying you beans. So that's a regret people have. They come in, they say, oh man, I could have had these higher interest rates for so many years. Don't live in that regret. Just make that move the next day. You know, you can pay the price of discipline. You can pay the price of regret. There's always a price to pay. You might as well pay the price of discipline. Just move that money, have a disciplined cash management plan, hire somebody to help you. It can be intimidating. Anytime you move a bunch of money around on the internet, rightfully so, the kind of alarm bells go off because I hope I don't click the wrong button here. So partner with somebody, pay somebody for financial advice. I think hourly is best, but find help. Too much credit card debt. This probably doesn't need explanation. Dave Ramsey has made an entire career out of this, and I think done a wonderful job for his country and all his listeners. Just, it's bad, 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 bad. The longer you carry it, the more deeper the hole you get in. And I've found the most effective marketers in the universe are credit card companies. So just know that. They're coming for you. They're coming for your children and your grandchildren. And so information and education is what's going to help not carry balances. You use it, don't carry balances. Not saving for emergencies. This is another Dave Ramseyism. You got to have an emergency fund. That's just all true. It just keeps you. Without one, every emergency will just put you in a dark spot, typically using credit cards. So 3 to 6 months of savings is what Ramsey recommends. I think that's fine. For some people, I'd take it up to 12 months. It's a big goal, but for volatile careers and earning profiles, it's helpful. And then buying too much property. One of my favorites. Don't buy too much house. Just all those phantom costs. I've talked about this last week. They just sneak up on you. You don't know. You didn't know the AC unit would die year 3, and wouldn't you know it? Those prices are crazy. So, final article, same magazine. Can active ETFs outperform into more portfolios? This is by Tobias Salinger. Subheadline, passive funds reached a long-anticipated milestone that likely won't be reversed anytime soon. But these managers argue expertise has enduring appeal. Now, I must say, listener, I can have a bit of a skeptic's attitude when I read these articles, and I can think to myself, all right, I got this magazine for free in the mail. Are they trying to sneak in articles that are trying to convince me that I need to put active products in clients' portfolios? It just crosses my mind. I just want you to know, that I'm thinking that. But let's give them the benefit of the doubt. Let's say this is objective journalism, even though I am suspicious. The article effectively explains that, hey, the exchange-traded fund phenomenon, and by way of review, exchange-traded funds are just like mutual funds, except that they trade throughout the day. And so they will trade at a slight premium or slight discount to their net asset value, whereas mutual funds trade once a day at whatever the net asset value is at that strike, and that's your sale price at the end of the day. Whereas these ETFs, exchange-traded funds, the innovation here is that they're cheaper to run and manage, and they trade throughout the day. So ETFs are very popular. What's happened is the great majority of money that moves into ETFs are in passive, low-cost strategies. Yay, very good. What have the legacy providers, the incumbents, done with that? They have bled assets precipitously. So this article talks about an effort by Capital Group. This is one of the largest active mutual fund companies in the world. I could probably run across them more than any other active fund. Capital Group partners with advisors, or has historically, where advisors will recommend Capital Group mutual funds. These are active funds with much higher prices. And in many instances, the advisor will make a small cut of whatever the expense ratio is. And that's how they're compensated for putting these mutual funds in client portfolios. And if you're thinking about it, you're thinking, it doesn't seem that objective. It's because it ain't. But that's just the way it was done for so many years. So here's this new push. This group, Capital Group, is seeking to put exchange-traded funds that are actively managed, that are lower priced than the mutual fund, but certainly higher priced than the low-cost index funds. And they've got a whole lot of reasons for doing it. They think, here's a quote, particularly on the bond side, they say active income ETFs are, we believe, going to be the asset allocation story of the year. Oh, wow, of the year. And this is as if you thought there was going to be an asset allocation story of the year. But if there was one, Mr. Framstead says active will be the way to go. The article explains, many active managers view their technology and expertise as giving them the edge over the passive products. The quote here, the case for passive, in my mind, is not a very strong one in fixed income. This is Neuberger Berman Group CEO George Walker told Bloomberg. So here we go, Capital Group saying, we think this structure can be incredibly beneficial, and you no longer have to sacrifice active management. The idea being that just because you go to ETFs doesn't mean you sacrifice active management. This is a Capital Group head of product strategy, Holly Framstead. So with all of these quotes, we can refute them with the SPIVA report, SPIVA. It actually shows us what percentage of the active fixed income funds outperform their index, what percentage of the active mutual funds outperform their index. It's about 5% over a 15 to 20-year period. The data will vary a touch over different time frames, but pretty clear. So I think this is all to the good. If I can speak positively, I'm grateful that Capital Group is lowering their prices. This is something that we want to applaud, that the industry is responding to the customer who says low cost matters to them, but there's not value for you. So we can avoid it. And we can avoid it because we've got a philosophy of investment. And you know what that is. We're going to keep our costs low, our investing simple, and our time horizon long, because that's what's going to give us the best shot on our investing journey.